we are learning about a profitability ratio. Okay, so in that we are learning about return on equity. So profitability ratio basically measures the profitability or the operational efficiency of the firm. Okay, this ratio reflects the final results of the business operations. The results of the firm can be either evaluated in terms of earning with reference to a given level of assets or sales or the owner's interest. Therefore, the profitability ratio can be bifurcated into three basic categories. Profitability ratio that are required for the analysis from owner's point of view, profitability ratio based on some assets or investments, and profitability ratio based on the sales of the firm. So this return on equity is profitability ratio for analysis from owner's point of view. Okay, so return on equity is equal to your profit after taxes divided by your net worth. Okay, so profit after taxes but before distribution divided by your net worth. Now let's see how to calculate net worth. Now there are two approaches of calculating a net worth. Okay, so one is your net worth is equal to your equity share capital plus reserves and surplus minus accumulated losses minus miscellaneous expenditure, okay, plus your preference share capital. Okay, so basically net worth is, in this formula if we calculate net worth, it will be your shareholders fund minus accumulated losses and miscellaneous expenditure. So that means your assets excluding fictitious assets minus liabilities. Okay, that is your debt and the current liability. This is one of the formula of calculating a net worth. Now if we want to calculate net worth from the equity shareholders point of view, what we need to do is we need not add the preference share capital. Okay, we just have to add equity share capital plus reserves and surplus less accumulated losses less miscellaneous expenditure. We need not add preference share capital as the dividend paid to the preference share capital is fixed. Okay, so they won't get any part from the profit other than their dividend, right? They won't get any additional dividend. Okay, so in that case we won't be considering the preference share capital. Now depending on your denominator, you have to adjust your numerator. Okay, the numerator says profit after taxes. Okay, so if you include preference share capital in denominator, okay, then you can take profit after taxes. But if you don't include preference share capital in the denominator, from profit after taxes you have to reduce preference share dividend. So what it will be? It will be your profit which is available to equity shareholders divided by net worth, wherein preference share capital is not included. So these are the two approaches in which you can calculate your net worth. Now we'll see one example, okay, on how to calculate your return on equity. Now following are the details in the books of ABC Limited. Earnings before interest and taxes 80 lakhs, interest on debentures is 10%, value of debentures in balance sheet is 2 crore 40 lakh, income tax is 50%, proposed dividend. Now this proposed dividend is a proposed dividend on equity shares. 20%. Share capital is 1 lakh, equity share of rupees 100 each, 1 crore. Share capital 50,000, 10% preference shares of rupees 10 each, 5 lakh. And reserves and surplus excluding current year profit is 50 lakh. Now we need to calculate what is the return on the equity. Before calculating return on equity, let's find out what is the earning after tax. Okay, so let's prepare one statement for computing earning after tax, okay, and earnings available to equity shareholders also. Okay, now EBIT is 80 lakhs. Okay, then less interest. Okay, so before reducing a tax provision, will reduce the interest, since the interest is allowable expense for the purpose of taxes. So how much is interest? 10% of 2 crore, 40 lakh. So that comes to 24 lakhs. Okay, so 80 minus 24 lakh, that is 56 lakhs. Okay, so now 56 lakh, after reducing interest, what you need to do is less your tax expense or tax provision. How much is a tax provision? Tax provision is 50%, right? So tax provision 50%, 50% of your earning before tax, that is 56 lakhs. So that comes to how much? 28 lakhs, right? So now earning after tax is 28 lakhs. Okay, now we will also find out what is the earning available for equity shareholders. So less your preference share dividend. So how much is the preference share dividend? It is 10%. Okay, so 10% of 5 lakh. So 10% of 5 lakh, it comes to 5 lakh, it comes to 50,000. Okay, so your earning after tax less preference share dividend, it is 27 lakh 50,000. That is earnings available to equity shareholders. Now we'll reduce dividend proposed to equity shareholders. Okay, now what is the proposed dividend to equity shareholders? Proposed dividend is 20%, and how much is equity share capital? 1 crore. So 20% of 1 crore, so that comes to 20% of 1 crore, so it comes to 20 lakhs. So your 7,50,000 is your profit to be carried forward, okay, in the balance sheet. Now we'll find how to calculate the net worth. Okay, so let's see how to calculate net worth. Net worth. Okay, now there are two ways of calculating net worth. One is including preference share, another one is excluding preference shares. Okay, so first we will calculate including preference share. So net worth including preference shares will be your equity share capital Okay, so how much is the equity share capital? 1 crore, right? So 1 crore, equity share capital is 1 crore, okay, plus your reserves and surplus. Okay, so how much is your reserves and surplus? Your reserves and surplus is reserves and surplus is 50 lakhs. So 50 lakhs, 50 lakhs. Okay, now this is excluding current year profit, 50 lakhs. So we have to add current year profit, that is 7,50,000, right, plus your preference share capital. So how much is the preference share capital? 5 lakhs, right? So preference share capital is 5 lakh plus preference share capital, that is 5 lakh. So your total will be, total is 1,62,50,000. Okay, now we will calculate net worth excluding your preference shares. Okay, so we'll take 1,62,50,000 less preference share capital, which is included above, that is 5 lakh rupees. So that comes to, so it comes to 1,57,50,000. Okay, so this is how you calculate excluding preference share. Now we'll calculate what is a return on equity including preference share capital. Okay, since we are taking including preference share capital, what we'll do is we'll take earning after tax, that is preference share dividend which is distributed, we won't consider that. So we'll take earning after tax. So how much is earning after tax? 28 lakhs divided by 1,62,50,000. So that comes to into 100, so it comes to 17.23%. Okay, now let's calculate return on equity excluding preference share. Okay, so return on equity is equal to, now since we are excluding the preference shares from the denominator, we will reduce the preference share dividend which is paid to them. So 27,50,000 27,50,000 divided by 1,57,50,000 into 100. So how much does that come to? 17.46%. So since the amount of preference share were less, very less as compared to the equity share capital and reserves and surplus, okay, and current year profit, okay, the percentage of preference share capital was very less. There is not much difference when you calculate your return on equity including preference shares and excluding preference shares. So this was about the return on equity. Thank you.